Hello, I'm Jeff Schmidt, Vice President of Financial Modeling at Corporate Finance Institute. Welcome to CFI's Introduction to Business Valuation course. In this course, we'll cover a core skill set needed by all financial analysts. We'll discuss why valuation matters. We'll look at a wide range of valuation methods and the pros and cons of each of those methods. Valuation is part art and part science. Because of this, valuation is ultimately subjective. However, we'll steer you in the right direction to use the most appropriate valuation techniques. We'll start by making sure you're clear on the difference between enterprise value and equity value. We'll then look at the three main business valuation techniques: discounted cash flow valuation, comparable company valuation, and precedent transaction valuation. We'll finish off by showing you how to present your analysis in a way that will make you a world-class financial analyst. This course is structured with a range of video lectures, followed up with exercises and interactive case studies where you have to apply the business valuation techniques in Excel. We've also included assessments wherever possible so you can test your knowledge. This course is not only good for beginners, but it will also cover some more intermediate discussions for experienced practitioners. We also have even more in-depth courses on DCF valuation modeling and comparable valuation analysis for those of you who want to build on the skills you learned in this course. We have a lot of exciting material to cover. Now let's dive into the course and get started. So what is valuation? Well, it's the art and science of attributing value to an asset, investment, or company. How do we know what it is a good investment and what's a bad investment? Sometimes these are obvious. We all typically agree a house is a better investment than a car. The house is usually an appreciating asset, while the car is a depreciating asset. However, it's not always that obvious. Take, for example, two publicly traded supermarket chains. How do we know which is the better investment? We would have to review those companies' financials and think about how they might perform in the future, and invest in the one that we think will be the better performer. Now let's talk about why. Why perform business valuation at all? Well, there are many reasons to value a company. We may be buying or selling a business, or raising money, like in an initial public offering or an IPO. Research analysts make buy, sell, or hold investment decisions and communicate those findings to investors. Internal decision makers at companies use valuation to make informed decisions. While there are many other reasons to perform a valuation, as shown in the bottom row, we are going to focus on valuing a business for investment purposes. We've said valuation is both an art and a science. The science part is pretty easy. We can review a company's financials and calculate various ratios. We can look at the company's track record or its performance over time. We can also apply various statistical calculations using company data. The more difficult aspect is the art of valuation. We would need to evaluate the management team, the company culture and strategy, whether the company has a sustainable and defensible moat. In other words, does the company have a long-term competitive advantage versus its competitors? Also, forecasting is an art. We have to look at all of the topics we've listed to help us predict how the company will perform in the future. Let's look at an example of the relationship between the art and science of valuation by looking at ratios and forecasting. With regards to the science part of valuation, we can look at the past performance of the company using common calculations, like return on equity. This is an easy and very common calculation. All we need is the company's net income and its shareholders' equity. We can then calculate return on equity and look at how that ratio has changed over time. We can do the same with other ratios or calculations. This is just simple math using a company's financials. The more difficult part is trying to forecast company performance into the future. This is where the art comes into play. In order to project things like revenue, profits, or cash flow, We must have a deep understanding of the business and where it's going for our forecast to be meaningful. We need to be able to assess company management. How is their track record? Is the company culture one of innovation? We also need to know a lot about the industry it operates in. What is the nature of competition in the industry? How competitive is the company with regards to its peers in the industry? What are particular challenges or threats to the company we wish to consider? There are also microeconomic considerations like supply and demand for the industry's products, as well as what is the optimal product price to maximize revenue. Finally, we should also consider the macroeconomic environment. What is happening with interest rates, foreign exchange, and any other macroeconomic condition that might impact the value of a company. This is all we mean when we talk about the art of valuation. And based on all of this, we can then apply acceptable valuation methods to determine what a company's worth. For more on analyzing a business, we recommend you check out our course titled Analyzing Growth Drivers and Business Risks.
Continue learning. Join CFI today.